Okay. Good evening, everyone. My name is Isemi Christiana, and I'm here to teach you guys accounting. So we'll start with what's accounting. Accounting can be defined as the process of classifying, creating, summarizing, interpreting, and communicating financial information to help in making specific decisions making. So you have to know accounting just deals with classifying, it deals with creating, it deals with summarizing, it deals with communicating and interpretation of your financial transactions. So you need to know the history of accounting. What is accounting all about? How does accounting start? What was the history of accounting? Accounting started in Mesopotamia in 14,000 years before Christ, and the father of accounting is Luca Pacioli. He's also known as the dawn of accounting. He was born in Italy in 1447. So he was the backbone of accounting. Let's just call him the backbone because he was one of the fathers of accounting that started he was part of those that started the formation of accounting as a whole. So accounting started in Italy. Luca Pacioli wrote a book. He published as the Somma di Arithmetica Geometrica Proportioni et Proportionalita. The meaning of it is the summary of arithmetics. I should write it. Okay. He published a book in 1494. The name of the book is called Summa de Arithmetica. So Luca Pacioli, the dawn and the father of accounting, published a book called Summa de Arithmetica Geometrica Proportioni et Proportionalita. This interpreted as the summary on arithmetic geometry. That's the summary on arithmetic geometry and proportion. So that is what this book is all about. So it was the backbone of accounting. He published this book in 1494. So that's the major key aspects you will need in your UTME preparation based on the history of accounting. You have to know the father of accounting, which is Luca Pacioli. He's also known as the dawn of accounting. He published this book in Italy at the year 1494, and the name of the book he published was Summa de Arithmetica Geometrica Proportioni et Proportionalita. So that was the name of the book he published, and he was the one that created the double entry principle. And you all know what the double entry principle states. The double entry principle states that for every debit transaction there must be a corresponding credit transaction, and for every credit transaction there must be a corresponding debit transaction. So that's all about the history of accounting. Then you go keeping is the summary, the summarization of your day-to-day activities, your day-to-day transaction, like day-to-day activities that take on in your business and all. So you have your personal accounts and your impersonal accounts. So your personal account just deals with your debtors and your creditors. You have the debtors account and your creditors account. You can also have your supplier account and your customers account. Your customer account. So that is that about your personal accounts. That's all. And your impersonal account is classified into your real account and your nominal account. So your real account comprise of your your tangible possessions, like your land and building, your furniture and fittings and all. While your nominal accounts consist of your intangible accounts, such as your goodwill, your salaries receivables, your salaries and wages, your commission receivable, your discounts receivable, your interest receivables and all. So your account is classified into your personal and impersonal account, and your personal account is classified into your suppliers, your debtors, your creditor and your customer account. While your impersonal account, the difference between your real account and your nominal account is that real accounts deals with tangible possessions, things that you can see, things that you can feel, things that you can feel, yes, things that you can see, like your land and building, your furniture and fittings and all. While your nominal account deals with your intangible possessions, like your goodwill, your commission received, your salaries and wages, your interest paid and all. So that is that about the classification. Of accounts. So now we move to your source document. But before I move to your source documents, you have to know your users of accounting. Users of accounting, you have your indirect users and your direct users. Your direct users of accounting just consist of three. They are just three. You have the owner of the business, you have the employee, and you have the employer. You have the owner of the business, the employee, and the employer. Those three consist of your direct users of accounting information. While the indirect users of accounting information, you have your lenders, you have your creditors, you have your trade, your financial institutions, you have your government and all. What the lenders needs your financial information to do is your ability to repay the loan they've given you. How the business has the ability, the capability to repay such loan. That's what the lenders needs your financial information for. Your suppliers needs your financial information to know if the business is still capable of them if the business is still capable of them repaying the amount, like your business is still capable of supplying goods or supplying goods into your company. That is, if you still have that ability to contact them to supply a particular goods to their company. And the financial institution also needs your financial information to know how the ability of the business, like the ability of the business to repay the loan they've given to them. And your investors, the investors need your financial information to know their risks on investment and their return on investment. After investing in your particular company, what will be their gain, what will be their loss? So that is what the investors need your financial information for. And the government also needs your financial information to ensure that your company are following the rules and regulations stipulated by a particular organization or body. And the body governing a particular company is your CAMA. You have the Company and Allied Matters Act. So the government ensures that that particular company or that particular business is following the stipulated rules and regulations. So I go again. The two users of your accounting information are your direct users and your indirect users. And your direct users consist of your owners, your employee, and your employer. That is that. And the next one, your indirect users consist of your lenders, your trade creditors, your suppliers, the government, investors, and so on and so forth. So that is that about that. So now the next one I would like to go into is your accounting concept and your accounting convention. As an accountant, as a person preparing a financial statement, you need to know the stipulated rules and regulations. You need to know the guidelines you have to follow in the preparation of your transactions. So we have accounting concepts and we have accounting conventions. What are accounting concepts? Accounting concepts are the rules and regulations, the guidelines that you follow in the preparation of your accounts, of your financial transaction, or in the preparation of your book of financial statements. So accounting concepts, the concepts of accounting just shows you the rules and regulations you follow, the rules and regulations, the steps you need to know, the basic assumptions you need to know. Yes, they're also known as the basic assumptions you need to know in your preparation of financial statements. And what are accounting conventions? Accounting conventions, these are the customs and principles that help in guiding your accounting concepts, that the customs and principles you follow in the preparation of financial transactions are your accounting conventions. So accounting concepts, we have, for your accounting concepts, we have the dual aspect, you have the going concern, we have the business entity, what again do we have? We have the accrual concepts, we have realization, and we have the historical concepts. Why your accounting conventions? You have the prudence or conservatism. You have the substance over form. You have the materiality. You have objectivity. Yes, and that's about that. So these are some of your accounting concepts and your accounting convention. So now for the dual aspects, what the dual aspect entails is that, you know, from the word of dualism, dual means two. So what it entails is that for every debit entry, there must be a corresponding credit entry, and for every credit entry there must be a corresponding debit entry. What it entails is that for every giver there must be a receiver, and for a receiver there must be a giver. So that is what your dual aspect entails. For you to calculate, for you to record a particular transaction, you must, the transaction must consist of two, that is the one giving and the one receiving, the one you ought to debit and the one you ought to credit. Then the next one is going concern. The next one is going concern. What your going concern concept just states that an entity should presume business, or an entity should assume that a business is continuing to go into an unforeseeable future without the aim or the notion of winding up. That is, the business is expected to continue to operate in an unforeseeable future without the notion or without the mindset of winding up in the nearest future. That is, the business is continuing to operate for a long period of time. That is what's going concern concepts means, like the business is supposed to like go and continue for a long period of time. I guess you understand that. Then we have business entity. One business entity concept states that the business and the owner must be a separate entity. There must be a separate person. That is, the owner of the business must be different from the person. That's okay. The owner of this business is H&C Partners or H&C Ventures, and the owner of the business is maybe, let's say, Ola and stuff like that. So maybe Ola and whatsoever. Ola is the owner of the business, and the name of the business is H&C Ventures. H&C Ventures must be different from Ola. Ola and H&C Ventures must serve as a different person. They must be they are a different entity. H&C Concepts has a legal right to sue and be sued, and the owner of the business is a separate legal entity. They are not together. So what business entity is just trying to tell you that the business and the owner of that business are a separate legal entity. They are not one. They are two different persons. So in accounting, they see a business as a person, and they see the owner of the business as another person, not the owner and the business as the same person. They are two different individuals. Then the next one is we have the accrual concepts. This accrual concept, it can be a little bit confusing, but if you pay attention, you'll be able to grab it. Accrual concepts states that your income must be recognized when earned and not when received. and your expenses a particular business, or once you come in contact with a particular contract of receiving a particular set of money at a particular date, then you have to record that amount of money. It assumes that yes, that money has been received, and not when your money has been received physically. It's record it when it is being earned and not when it is being received. And your expenses, you record your expenses when it is being incurred and not when it is being paid for. Just like you come to buy a particular good, and let's say you buy the goods on credit, so the accountant recording that particular transaction must record it immediately, even though the creditor or the debtor has not paid for that particular goods. So you record these goods. So you record this for your expenses. You record your expenses when it is being incurred and not when it is actually being paid for. Not when they've paid for that particular expense, but when they've incurred that particular expense. And you record your income when it is earned and not when it is being received. You are supposed to earn your income at the end of this month, then you record it, not when you have actually received the money. You are supposed to pay for this particular goods. You record it immediately you earn, immediately you incur it, not when it is being paid for. And realization concept, the difference between realization concept and accrual concept is just a slight difference between. Realization concept is just trying to tell you that your revenue are recognized when you earn it and not when it is being received. And your historical concept just states the fair value basis of a particular amount of money, the real amount, like the actual amount of money, the market value of that particular goods is to be recorded in your financial transaction. When you want to record a particular expense, or when you want to record a particular transaction, you record it based on their fair value, based on their market value and all. Then the one I omitted was your money measurement concepts. So your money measurement concepts, this concept just states that any transaction that is in a monetary term should be recorded in your financial statement. Only transaction that is appeared, or only transaction that can be measured in monetary term should appear in your accounting concept. I repeat, only transaction that can be measured in monetary term should be recorded in your financial statement. So that is that about your accounting concepts. Then your accounting conventions. Now the first one here is your prudence or conservatism concept. So what your prudence concept is just trying to tell us is that your income should not be anticipated, your losses should not be, your income should not be anticipated for until all your losses has been calculated. That is, you should not anticipate your income, you should not anticipate your profit on a particular transaction until all your loss has been calculated for, until all your loss has been settled. Until you settle all your loss, you don't have any liability, you don't have any owings anywhere, then you anticipate for your income. That is what prudence convention is all about. Then we have the substance over form. The substance over form, you can also regard it as your reality over legality. So in your recognition of your financial statement, you have to put the reality first over your legality. You have to put the real transaction, what happened, the real aspect of that transaction over the legality. Legality means legal and all. So what this substance over form means, that the substance over the form, the actual amount of that particular goods must be recorded over the legal aspects, over the legal substance. Then you have your materiality. Your materiality conception. What materiality conception states is that if a particular transaction or if an omission in a particular financial statement of a business, if it has the ability to affect the decision making of that particular business, then such transaction is said to be material to that particular business. So now let's say like a business, now let's say Dangote and all. So if Dangote lose, let's say like 100,000 naira in a particular trade or in a particular transaction or whatsoever, it might not be material to his own business, like the way it will be material to another business. So what this materiality convention is just trying to say is that if the omission of that particular transaction has the ability or have the capability to affect the financial statement of a particular business, then that item is said to be material to that business. Then we have objectivity. Objectivity, what objectivity just is that in your preparation of financial statements, you must be objective, you must be objective, you must be fair and just in your recording of financial statements and all. So that is that about your accounting concepts and your accounting convention. So now we move to your source documents. Source documents. What are source documents? Source documents are the written transaction of a business that your source documents are written transaction of a particular business. When you purchase a particular goods or service, you will be given a paper trail. So what that paper trail just implies is your source document, your written transaction, your written evidence. They are the written evidence of a particular transaction. So now your source documents are your invoice, they are your receipts, they are your debit notes, they are your credit notes, they are your journal and all. So I might not give you the full definition of your source documents, because a lot of us know the meaning of receipt, a lot of us know the meaning of invoice, a lot of us know the meaning of purchase, payment voucher and all. But the only one I'm going to explain is your debit note and your credit note. Debit note and credit note is also a slight difference between the two of them. Debit note and credit note are also your source documents. What are credit notes? Credit notes are documents issued by a seller to the buyer. Debit notes are source documents issued by the seller to the buyer to correct undercharged. Yes, if I'm not mistaken. Yes, debit notes are source documents issued by the seller to the buyer to correct undercharge. Why credit notes? Credit notes are source documents, or they are documents issued by the seller to the buyer to correct overcharge. So the difference between your debit note and your credit note is overcharge and undercharge. Credit notes are issued to correct an overcharge, while debit notes are issued to correct an undercharge of a particular goods and service. Then what's your journal. Your ledger. Your ledger is the principal book of accounts that summarizes the permanent, that shows the summary of a particular transaction, that the permanent record of a business transaction and all. Then you have your trial balance. Trial balance, this is a statement that shows the list of balances in a double entry form to test the arithmetical accuracy of an account. So your trial balance is the statement showing the classification of goods and services in your ledger that are transferred from your ledger to your trial balance. So now your trial balance is divided into two. You have your particulars, your debit and your credit. The rules of trial balance states that all assets must be debited and all liabilities must be credited, while all expenses must be debited and all incomes must be credited. So trial balance rule, you must follow the rules of trial balance to ensure that your account balance in preparing your accounts, in preparing your financial information. The rules of trial balance must be observed, and the rules of trial balance are all assets must be debited, all expenses must be debited, likewise all liabilities must be credited, and all income must also be credited. But in the preparation of your trial balance, you can have errors that affect trial balance, and you can have errors that do not affect trial balance. So in the errors that do not affect trial balance, you have the error of omission, You have the error of omission. You have the error of principle. You have the error of principle. You have the error of commission. You have the error of original entry. You have the complete reversal. You have the complete reversal of entry and so on. There are many more, but these are the key ones you need in your preparation for your exam, JAMB and all. So now the error of omission, what this error that do not affect trial balance implies that in your preparation of trial balance, there's some errors that you make, like it will not affect it at all. It will not show, like it will not be obvious in your preparation of trial balance. Even if you commit such errors, your transaction, your trial balance will still balance. So now the first one is error of omission. What you're supposed to record in your financial statements, you did not record it at all. You omitted it. Then it will not affect your preparation of trial balance. Your trial balance will still balance. Then the next one is we have the error of principle and we have the error of commission. The error of principle and the error of commission, some people mistake one for another. So now what's the error of principle? Just states that when you record the correct amount in the wrong class of accounts, when you record the correct amount in the wrong class of accounts. Now let's say a sale of motor expenses of 500 naira was recorded in motor vehicle accounts. Motor expenses and motor vehicle are two different classes of accounts. When you're supposed to record the sales of motor vehicle 500 naira in motor vehicle accounts, then you recorded it in motor expenses accounts. There are two different classes of accounts and it will not affect your trial balance at all. Now the next one is your error of commission. Your error of commission occurs when the correct amount is entered into the wrong person's account. So now let's say salaries of wages paid to Tunde 500 naira was entered to Taba account. Tunde and Taba are two different persons. So the amount of money you are meant to record in Tunde's account, you meant to record it in Taba's account. It will not affect your trial balance at all. Your trial balance will still occur. The error has occurred, but it will not affect your trial balance, and your trial balance will still balance. So now the next one is the error of original entry. Error of original entry occurs when the sales of goods for 940 naira was entered into the book as 490 naira. That is an error. An error has occurred when you are supposed to record a sales of goods for 490 and recorded it as 940. Then there's a mistake, there's an error in the amount of that particular goods. When you record it in your financial transaction, it will not affect your trial balance. Your trial balance will still balance. Then we have the complete reversal of entry. The complete reversal of entry is negating the double aspect of financial transaction. So now your complete reversal of entry occurs when the accounts you ought to debit, you credit it, and when the accounts you ought to credit, you debit it. You are supposed to credit your income account, you debited it, and you're supposed to debit your expenses account, you credited it. So such an error has occurred, but it will not still affect your trial balance, still balance. So that is that about the errors that do not affect trial balance. And as you have the errors that do not affect trial balance, you also have the errors that do affect trial balance. You have the errors that affect trial balance. You have the one-sided omission or one-sided omission or one-sided entry. Sorry, one-sided entry. One-sided entry. This one-sided entry, the errors occur when for a transaction. We all know that the principle of double entry states that for every debit entry, there must be a corresponding credit entry. And for you to record a particular transaction, you record it twice. That is in the debit side and in the credit side. So what's one-sided omission? One-sided omission. The errors in one-sided omission that occur is that you are supposed to record a particular transaction in the debit side, then you recorded it in the debit side, and you do not record it in the credit side, then a particular error has occurred. And Okay. Okay. Errors that affect the trial balance. The first one is one-sided omission. Sorry, one-side omission. So when you are supposed to debit for, you all know that in accounting, the dual aspect is very compulsory and it's very important in your recording of financial transaction. So you are supposed to record a transaction. Transaction is supposed to have a debit side and also have a credit side, because for every receiver there must always be a giver. So you record a particular transaction in the debit side and you did not record it in the credit side, it's going to affect your trial balance. It's going to affect your balance in the trial balance. So that is when the suspense account comes in. Suspense account is a temporary account. It's the account in which errors are recorded temporary until the errors are detected. So the suspense accounts are used to record errors that affect trial balance. They can be used as a supplementary account to record errors that affect trial balance. Suspense accounts are accounts in which transactions are temporarily recorded until the errors are detected. So once the errors affect your trial balance, that is when your suspense account comes in. So now let's take a question. If the question states that a sale of goods 500 naira was entered, a sales of goods for 500 naira was entered in the cash account and it was not entered in the sales account, that is an error of one-sided omission. It was entered in the sales account, then you did not record it. It was entered in the cash account and it was not entered in the in the sales account. Sales of goods 500 was debited in the cash account and was not recorded in the corresponding ledger account. So how can we correct this error? A sales of goods of 500 was debited in the cash account and was not recorded in the corresponding account. A sales of goods was of 500. The two accounts that is affected is your sales account and your cash account. Now your sales account is credited. You are supposed to credit your sales account and debit your cash account, but you only debited your cash account and you omitted the other corresponding account. So now for you to correct this account, you are going to debit your suspense account and credit your sales account. So this is how to correct the particular error. You indicate, okay, this particular error, what was the error that occurred? Which error occur in this particular transaction is that the sales of 500 naira was not recorded, but it was recorded in your cash account. So now to correct that corresponding error, and you know that your sales is to be credited with 500 and your cash is to be debited with 500, but cash is debited already, then you don't have any issues with cash. The only one you have issue is with sales, and you cannot record sales alone. Based on the dual aspects, you must have a debit entry and must also have a credit entry. So now your debit entry, you represent the other account as suspense account, then the other one as sales account. So you credit your sales account and debit your suspense account. So that's how you correct your errors that affect trial balance. So you also have misposting of figures. You also have when you the total in your subsidiary ledger, that is the total in your subsidiary books, you do not post it the way it is. Let's say the amount is 490, you posted it as 940, then it will affect your account and all. So that's about that. So now let's go to bank reconciliation statement. So now we have our bank reconciliation statement. So now your bank reconciliation statements. What are bank statements? Bank statements, these are statements that are prepared by the accountant in charge of your own account, that is recording the financial transactions that occur, transactions that occur in your banks, or that what, let's put it that bank statements is the statement that is prepared by the accountant to ensure that the statements in your cash book and in your bank statements are corresponding. That is the your bank statement is prepared by the accountant in charge of your particular account, prepared daily to record the transaction that occur in your bank. So what bank reconciliation statement does is that is the statement that used to reconcile the balances of your cash book and your bank statement. It's a statement prepared by an account holder. The statement prepared, is the statement prepared to ensure that the balance of your cash book and your bank statements are equal. They are reconciled, to reconcile the difference between your bank statement and your cash book. So bank reconciliation statements reconcile the difference between your bank statement and your cash book. I said that earlier. So how will I even put it? Okay, so reasons why your bank statement is not reconciled with your cash book, that reasons for bank reconciliation statements. There are diverse types of reasons why for the occurrence of bank reconciliation statement. You have your unpresented check, you have your uncredited check. You have your standing order. You have your standing order. You have your dishonored check. You have your dishonored check. You have your dividend. Then after your standing order, your dishonored check, you have your dividend. You have your direct debits. You have your receipts, undercasts, your payments overcasts, so now let's start with your unpresented check. Your unpresented check, this is a particular check you present to the bank, but it has not yet been recorded in your bank statement. That is, you present a particular check to the bank. That particular check has been recorded in your cash book, but it has not recorded in your bank statement. It has been presented to the bank, but the bank has not recorded it in the bank statement. So now your uncredited check, it has been recorded in your cash book. It has entered into the bank, but the bank has yet to debit that particular customer, or the bank is yet to credit that particular customer. Yes, it has entered your cash book. It has entered the bank. It has been accepted by the bank, but the person preparing the accountant preparing that particular bank statement has not yet recorded that particular transaction into your bank statement. Now you have the standing order. So what is the standing order? This is first to as the order that you gave the business to pay on behalf of you, like on your behalf, and the order you've given the bank to pay on your behalf. Such order, it can be your data subscription. It can be your data subscription, it can be your decoder subscription, and all. The order you've given to the bank to remove money in your bank account at so time, at a stipulated time period. Those are the standing order. So the bank has already recorded it in the bank statement, but the cash book is yet to record it. So that is what caused the difference between the bank statement and your cash book. So what bank reconciliation statement is to reconcile this difference between the bank statement and the cash book. The other one is the dishonored check. The dishonored check, you've recorded it in your cash book, but the bank did not honor that particular check. These are checks that are entered into the bank, but the bank did not honor it. And reasons for a check, like why are some check dishonored? Why does the bank dishonor a particular check? It can be as a result of your irregular signature. It can be as a difference in words and difference in figures. It can be as a result of incomplete amounts in the bank. Let's say you have 20,000 in the bank and the check is showing you 30,000. To withdraw 30,000 from that particular bank, the bank is not going to accept such check. And if your check is a stale check, and what is a stale check? A stale check is a check that is being presented after 6 months of after it has been presented to, let's say, after 6 months. So now let's say I gave you a check at so time. So after 6 months, if you did not present that check within the time I present that check to you and the time you want to withdraw the money from, or you want to deposit it to the bank, it must be between the period of 6 months. If it's more than the period of 6 months, then the check is said to be a stale check. Then the bank is going to dishonor such check. The bank is going to dishonor such check. So that's about your dividend, your dishonor check. Then you have your dividend. This is the profitable, like your share of profit as a shareholder. So it's always debited into the bank. Then the next one we have our bank charges. This refers to as the charge that the bank withdraw. Like this is the amount of money the bank withdraw from your bank intermittently. Bank charge, you can have your SMS charge, you can have your let's say those amount of money that the bank withdraw, like those amount of money that the bank withdraw from each transaction. So now let's say some few amount of charges, let's say your SMS charge, let's say your electronic transfer charge, let's say your electronic levy charge, the amount of money that the bank remove from your bank are classified as your bank charges. So that amount of money is removed from your bank, but they've not notified the owner of the account to remove such amount of money from your cash book. So that is going to cause a difference between the bank statement and also the cash book. Then the next one is your credit transfer. Credit transfer, this is the amount of money that's entered into your bank, but the bank did not notify the owner of the bank. So the owner of the bank will be made notice of that particular transaction when he has received the bank statement. So credit transfer are the amount of money that enters your bank, but the person holding, the person in charge of your bank statement, the person in charge of your bank account did not notify the owner of the bank account, except when the owner receives the bank statement. So that is going to cause a difference between your cash book and your bank statement, because the money has entered into your bank account, but you've not recorded it into your cash book. So it's going to serve as a difference between your cash book and your bank statement. So now in the preparation of your bank reconciliation statement, you can start as the balance as per your bank statements and balance as per cash book. So now you are starting with balance as per cash book. So now the balance as our cash book is this. So then we add our unpresented check. We had our unpresented check. Then we had our credit transfer. Then we had our dividend. So balance as per cash book, you are the owner preparing that particular cash book. The balance as per your cash book is this. So now we are going to add our unpresented check. And I said our unpresented check, this is the check that you've told the person to withdraw from a particular bank, but the bank did not record it. The bank did not perform any transaction on that particular check. Then you have to add it back to your cash book. Then our credit transfer, what our credit transfer back? This is refers to as the amount of money that enters into the bank, but you've not been notified. So you are going to add the amount of money to your cash book. Then your dividend, this is a profit of you being a shareholder, your profitable share of a shareholder of a particular company. You will add it back to your cash book. Then after that, we subtract our uncredited check. We subtract our uncredited check from our cash book, from the balance of our cash book. We are going to subtract this. Then we'll subtract our bank charges. We'll subtract our standing order. We'll subtract our dishonored check. Then so this will give us a balance as per bank statement. Remember in the earlier lesson, I said that the bank reconciliation statement is prepared to reconcile the differences between the bank statement and the cash book. So once you are giving the balance as per your cash book, there are some transactions that occur that you preparing the cash book might not be aware of. Like your unpresented check now, you've given it to the bank, you present a check to the bank, and you expect the bank to remove such particular amount of money, but the bank do not record it, the bank do not perform a particular transaction on such check. Then you will add it back to your cash book. Then your credit transfer, it has entered into your bank statement as a credit balance, but you've not debited it in your cash book. Your dividend has been credited to your bank account, but you do not debit it in your cash book. Then you are going to perform the financial transaction of those ones. Then your uncredited check, the uncredited check is you've removed it from your cash book, and you're expecting the bank to also remove it from the bank's account, but the bank did not remove it at all. Then you will remove it. You remove it from it. That is, you've added it to your cash book, but the bank have not added it back to the bank account. Then you are going to remove it. The bank charges, you are going to remove it because the bank has already removed such transaction from your bank account. Then you remove it also from your cash book. Standing order, you remove it also. Your dishonored check, you remove it also. Then after doing that, you will have your balance as per bank statement. Then you can start with your balance as per bank statement. Then you will add your uncredited check first, then later subtract your unpresented check. So that is that about your bank reconciliation statement. So now we move to the So now we move to the financial statement, or the final account for a sole trader. The final account for a sole trader, that is the account that comprises of your trading account, so now we have our trading account. We have the statement of profits or loss. Then we have the statement of financial position. So the statement of financial position. Statement of financial position is what we all know as our balance sheet. So it's not more called our balance sheet. It's also now called or regarded as our statement of financial position. So now your trading account is prepared to ascertain your gross profit or gross loss. So as a sole trader, you prepare your trading accounts to ascertain your gross profit or your gross loss. So your statement of profits is prepared to know your net profit or your net loss, whether your business is making profit or your business is making loss. While your statement of financial position is prepared to show the financial position of that particular statement. It's comprised of your assets, your liabilities, and all. So your trading account and your statement of profits or loss and your statement of profit or loss. So now your trading account, when you want to solve a question pertaining to the statement of your profit or loss, and they ask you to get your gross profits, or they ask you to get your cost of goods sold, then this is how you go about it. You start with your sales, then if there is a return inward, you subtract your return inward. You subtract it, then it's going to give you your net sales. You might not see it as sales in your question, you might see it as revenue. Your sales is also known as your revenue. Then you get your cost of sales. Then with your cost of sales, you start with your opening stock. It's not more known as your stock again, it's known as your inventory. You have your inventory or your closing inventory. Your opening inventory. Then you add your purchases to it. You add your purchases, you will add your carriage inward. If there is return outward, you subtract your return outward from it. Subtract your return outward from it. So the addition of your opening inventory and your return outward is going to give you your cost of goods available for sale. Let's give you your cost of goods available for sale. Then you subtract your closing inventory from it. Subtract your closing inventory from it. Then it's going to give you this. Then you add your wages. If you are giving wages in the question, not salaries and wages, your wages alone, then you add it to it. Then it's going to give you your cost of sales. So it's going to give you your cost of sales. So to get your net profit is the difference between your cost of sales and your net sales that is going to give you your gross profit. If your net sales is greater than your cost of sales, you have a gross profit. And if your net sales is less than your cost of sales, you have a gross loss. As a result, course of your exam, they might not give you enough transaction or give you a lot of transaction as this, but the main thing for you to know is that to get your gross profit is the addition of your opening inventory plus your purchases plus your carriage inward minus your return outward minus your closing inventory will give you your cost of sales. To give you your cost of sales. So now to get your net sales is the addition of your sales minus your return inward. But sometimes most of the question they don't give us return inward, neither did they give us return outward. So if your return inward is not given, fine, you use your sales. But if your return inward is given, you are going to subtract it from your sales. They might not give you as sales, they might give you as revenue. So what you have here and what you have here, you subtract your cost of sales from your net of sales, then you have your gross profits. Equals to your net sales minus your costs of sales. So it's going to give you your net profit, and your cost of sales comprised of your opening inventory plus your purchases plus your carriage inward minus your return outward and minus your inventory. Note, it is carriage inward, not your carriage outward. Your carriage outward will be going to your expenses, and your carriage inward will be recorded under your cost of sales. It's not carriage inward you record here, but your carriage is not carriage outward, sorry, you record here, but your carriage inward. Your carriage outward is an expenses to your particular organization. So the addition of this is going to give you your cost of sales, and the whatsoever you get in when you subtract your sales and your return inward is going to give you your net sales. So if your net sales is greater than your cost of sales, you have your gross profit, and if your cost of sales is greater than your net sales, you have a gross loss. So that is that about that. And now for your preparation of profit or loss, that is now this with your expenses and your income. So the income, if you are using a T format, so after getting that, you all know that your gross profit is an income to the business. So now using a T format, your gross profit is here. Your gross profit is here. Then your sales and all is here. So you balance this. So this your gross profit, you bring it down because it is your income. So the credit side in your profit or loss is used to record your income statements, that is additional information. What you know as additional information, what you know as adjustment, it's also known as adjustment. So now you can have an adjustment of your accrued income. You can have accrued income. You can have it as accrued, outstanding, owings. Everything is still, you got income, your income. Can have your accrued, outstanding, owings, expenses. You can also have it. You can also have your prepaid income. You have your prepaid expense. Like I said earlier, it's only your income and expenses that will appear in your profit or loss account. So in your additional information, when you are giving your accrued, whether you see it as accrued or you see it as outstanding or you see it as owing, that means you are owing for that particular year or you are owing for that particular financial period of time. Then you are going to add it. So now let's say in the information we have our salaries and wages. Salaries and wages as 10,000 naira, and our additional information, that is our adjustment. Additional information, we have our accrued wages of 500. You have your accrued wages of 500 naira. In recording this particular transaction, you know that these salaries and wages will be recorded on the debit side of our profit and loss. For it is because it is an expenses, that's one. Then you are not going to record only this 1,000 naira. Note, there is an additional information that states that you are owing a particular wages and salaries. You are owing a particular wages and salaries of 500 naira for that accounting period of time. Then you are going to add it with your 10,000. So that means when you are recording when you are preparing your profit or loss account, you are not going to record only 10,000. You are going to record your 10,000. That is 10,000 plus 500. That is 10,500. So that is that about that. So now if you are seeing your prepaid expense, so now let's say we have our rent of 15,000. Then we have prepaid rent or rent prepaid for naira 1,000. So what prepaid means that you paid, like you've paid for what you are supposed to pay next year. You paid it. What you are supposed to pay next year, you paid for it this year. accrued wages, what you are owing, let's say the amount of money you are owing the last financial period or the last financial accounting period or as at last year, then you are owing 500 naira as at 2024, then you are supposed to prepare a financial transaction, a profit or loss statement for the year 2025, then you are owing that particular amount of money as at last year, then you are going to add it to it. So now what prepaid expense means is that the amount of money you are supposed to pay year 2026, you paid it in year 2025, then you are going to subtract this 1,000 from your 15,000, because this 1,000 is not for this accounting period, it is for next accounting period, so you are going to subtract this 1,000 from it. But this 500 naira you are owing, it is the amount of money you are owing from the last accounting period, then you are going to pay it this accounting period as per say you are owing it last time, so you are going to add it to it. So you'll be recording your 10,500 in your financial in your statement of profit and loss, and you'll be recording your 14,000 because you'll be subtracting 1,000 from your 15,000 in your financial statement of profits or loss. So now in recording your financial position, in recording your balance sheet, what we all know as our balance sheet note, only items that are recorded that are indicated in our additional information will go to our statement of financial position. Like our accrued wages is going to go to our financial position as a liability because of we are owing them. You are supposed to pay this particular amount of money at this stipulated time. You do not pay for that particular amount of money, then it's an owing to that particular organization. It's regarded as your liability. Then this your prepaid rent is your current asset. You record it under your current asset because you've prepaid, like the amount of money you are not supposed to pay for this accounting period that is meant for the next accounting period, you paid it this year, then you record it in your statement of profits or loss. So only items the additional information will appear in your statement of profits or loss. I guess I've been able to turn into your statement of profit or loss. I know. So okay, there is another additional information that you might find confusing. That is when we have our provision for doubtful debt or provision for irrecoverable debt and all. And what is bad debt? You know, bad debts are your debts that you cannot recover, your irrecoverable debts. Those are your bad debts. So now if you have your provision for doubtful debt, so now let's say in our financial information you have your debtors 50,000, you have provision for bad debts or provision for irrecoverable debts. Your bad debts are debts you cannot recover, they are your irrecoverable debts. Then you have that for let's say 15,000 naira. Then you have your additional information. You have your additional information. You have create 5% bad debt for debtors. Let's say we have our bad debts here again as 5,000. So we have our debtors 50,000, provision for that 15,000, bad debts 5,000. This bad debt 5,000 here recorded in this transaction means they've removed this 5,000 from the debtors. Your debtors before was 55,000, but there was a bad debt of 5,000. That's why you're having a bad debt of 50,000. But if the bad debt is in the additional information stating that we should remove a bad debt of 5,000 naira, then you are going to subtract it from your debtors. So now let us prepare this particular transaction. You have your debtors of 50,000 naira, a provision for doubtful debt for 15,000, a bad debt of 5,000. Then we have our additional information as one, create 5% bad debt for debtors and also your bad debt of 5,000 naira. This bad debt of 5,000 naira has already been recorded, has already been prepared, so we are not subtracting this 5,000 from our debtors. So now to record the amount of your net debtors, then you go by, you have your debtors of 50,000 naira, then you are going to subtract the bad debts of this 5,000, not of this one. Bad debts are debts that you cannot recover. Okay, bad debts are debts that you cannot recover. But if bad debts are debts that you cannot recover, so in this financial information they've given us that, okay, they've recorded this, they've already provided for 5,000 naira bad debt of the debtors, and here we have to provide 5,000 naira of our debtors, then we are going to subtract it. So bad debt is created when your debtors are owing you, but luckily for you, maybe something happened to them, maybe they died or something, or they went bankrupt, or they are not able to provide for your particular amount of money, then you are not able to recover that particular debt, then you classify it as your bad debt. So you remove this 5,000 naira from the amount of money your debtors are owing you, then that is that's 45,000. Then you create minus your provision for bad debts. Note, they gave us a provision for that bad debt that we should create a 5% for bad debts. So that's our 5/100 times 45,000. 5% of 45,000. Sorry. So 5 divided by 100 times 45,000. So that is 2,250. So that is 2,250. Then we'll subtract it. Minus 45, 1, 2, 3. So that is 42,750. So this is our net debtors. So now what I want to classify. This is the amount of money that will be going to our balance sheet as our amount for debtors, not 50,000. Our amount for debtors now is 42,750. This is the amount of money that we are going to receive, or that is the amount of money that will be our amount for our debtors. Then this bad debt is also going to our bank, our balance sheet. So now this provision for bad debt 2,250. Note, there was an information about provision for bad debt of 15,000. This is the old provision. Our old provision for bad debt was 15,000, and our new provision for bad debt was 2,250. The old one was 15,000. The new one was 2,250. So that was a decrease. A decrease in the provision for doubtful debt. So a decrease in your provision for doubtful debt is an income to an organization, while an increase in the provision for doubtful debt is an expenses. So yeah, you are going to record your increase in provision for doubtful debts for bad debts. You can see it as bad debts, you can see it as doubtful debts, you can see it as provision for irrecoverable debts. Then you record it here. Then your provision for a decrease in provision for doubtful debts or bad debts will be recorded under your income. So if there is a decrease, you record it under your income, and if there is an increase, you record it under your expenses. That's about that. And for your balance sheet, you know your balance sheet is classified into your equity, that's your capital. You have your balance sheet. So your balance sheet, you have your capital. You record your capital. You have your net profits. You add your net profit. You subtract your drawings. Then next, you go under your current liabilities. So now, under your current liabilities, you have your accrued expenses. You have your your prepaid income, you have your creditors, you have your bank overdraft. What are bank overdrafts? Bank overdraft, this refers to as the amount of money that is more than the amount in your bank account. Now, so let's say you have 50,000 in your bank account and you want to withdraw 60,000 naira. The 10,000 naira there is your bank overdraft. Bank overdraft is the excess of the amount in your bank account. Your bank account has 50,000 naira and you want to withdraw 60,000 naira. The 10,000 naira difference is your bank overdraft. Then to the other side, you move on to your non-current assets. Like I said earlier, you not record your assets in your profit or loss account. So your assets must not occur in your profit or loss account. All your assets will be recorded in the balance sheet. That is your land and building, your furniture and fittings, your premises, and all will be recorded here. And we have our current assets. Your current assets, you have your closing inventory, you have your cash, you have your bank, you have your prepaid expense, and you have your accrued income. Then you have, yes, your cash and bank. Then you have your rent prepaid. It's also known as your prepaid expense. Then if you solve a particular question given to you, then your account is going to balance. I guess I'll be able to dwell on your preparation of bad debts based on this particular question. I'll be able to dwell on the final account of a sole trader, and I guess that's part of the most important parts you need in the preparation or for your exam. So I guess this is where I'll be ending my class, and I just want to encourage you that you should prepare more questions. You should not give up. There's still time. If you not start preparing, there's still time and all. And you should prepare more questions, solve more past questions, and if you don't understand, you can still go back to each class and all. So I just want to wish each and every one of you success in your forthcoming examination. Thank you very much. And once again, all right, bye for now. Take care.
Not stop streaming. Not stop streaming. Now call you back.